Welcome, everybody. Thank you for attending today's QOZ3 webinar. I'm Michael Episcope. I'm here with David Scherer, and we are your co-CEOs. It's always a pleasure to do a webinar with David. We used to do all of these together, and now it's more divide and conquer and elevating other team members into this position, which is also nice and helps with our schedules a little bit. The purpose of today's webinar is to introduce you to our third QOZ fund. The documents are actually being finalized as we speak. The fund should be available for investment, call it right around June 1st, hopefully a little bit earlier. The lawyers are working on this right now. I'm going to cover about Origin, go over that briefly, QOZ law, high-level fund strategy, and target cash flow. Everybody always asks about that. And then Dave is going to cover our investment strategy, our pipeline, and go over a case study. And then I'll hand it back to me and I'll cover the remainder of the terms. And then we'll open it up for everybody's favorite part, which is the Q&A. Our part won't last more than 40 minutes. And then the Q&A, 20, 30, maybe even 35 minutes, depending on how many questions we get. But we are here for you to ask or to answer your questions. So if you have any, please put them in the question and answer box, not the chat box. It's always easier for us to work out of one area, and then we can delete those as we get them as well. So we're organized on our side. QOZ3, it's a carbon copy of our other two funds in terms of the strategy and terms. The only difference is the vintage. Very different vintage in 2023 than it was in 2019, 2021. And a lot of people are concerned about the environment, and I would say maybe rightfully so, but also just partially so. Vintage matters, but there's a few things that matter even more when it comes to investing, especially in real estate. What markets are you in? Where is the affordability? Where are the long-term growth rates? Putting yourself in a position where population, job growth, et cetera. And we have a history of being able to select the right markets. And Dave's going to talk about how our team is organized to be able to do that with boots on the ground. And then also how we use Origin Multilytics and use a data-oriented approach to be able to select the right markets as well. The other thing is your hold period. That actually matters more than vintage. And if we go back to the most recent time and period that most of us remember, had you bought a good quality multifamily property in 2007 and held it for the next 10, 15 years, you would have done extremely well versus not investing during that time and sitting on cash and waiting for the next 4 or 5 years, because by year 4 or 5, 2010, 11 of that time, you couldn't have recreated the same replacement costs and the same value of those properties. And that's one of the beautiful things about QOZ is that we are forced to hold for a minimum of 10 years. And I know for people like myself or like Dave, we're going to be in here for much longer, 10, 15, 20, even 30 years till the end of the program in 2046. The asset class is the other thing, multifamily. And that's one of the unique things about this fund is we are only investing in multifamily. And multifamily has an incredible track record. It has beat the performance of the S&P 500 on a risk-adjusted basis. It beats retail, office, industrial, and certainly on an absolute basis too. It has kept up with industrial and beaten retail and office over the years. So it's a very stable asset. It's a need-based asset and something that we obviously love here. And as a firm, it's all we do. So our strategy is really about being an inch wide and a mile deep. The other advantage that this fund has over the last two funds, I would argue, is the investing environment. And we are at the end of a tightening cycle. Inflation is coming down, construction costs are starting to soften, and the market is more normalized today than we've seen it in the last 2 to 3 years. Certainly since 2020, early 2020, it's been one of the most volatile markets that we have ever invested through, being able to manage construction prices, manage rent growth, just all the supply chain issues, et cetera. And I would argue that it's much more difficult to get a project approved today in a high interest rate environment than in a low interest rate environment, because when you increase all of the costs, the property has to withstand a lot more scrutiny. And it's really a good thing for this fund because projects that do get approved, they produce far higher margins. And if we go back just a couple of years, our return on cost, when cap rates were 3.5, 3.75, 4, it was around a 5.2, 5.3, right around there, and that still produced a 35% margin. Today, you wouldn't develop at a 5.2, 5.3% return on cost because the margin is just too small. It's 10, 15%, and that can disappear quickly. And that margin is what protects you against the erosion of value in the event that you are wrong. And today, our bogey is closer to a 6% return on cost. And what the return on cost is, it's a cap rate in the future. And so it's much higher on an absolute basis because cap rates are closer to 4.5. So we look at that spread between where current cap rates are and where we can build to. So in many ways, this environment, because the genie is out of the bottle, risk has reared its head, we're looking at the world through a very different lens and a very different set of assumptions. Now, our pipeline is certainly smaller as a result of this new environment, but we're still finding some really great deals, and we will discuss some of those in Dave's part, and then we can talk more about those in the Q&A. Let's jump into the presentation. At the highest level, we help high net worth investors protect and grow their capital. And we do this through investments in multifamily real estate. We have 3 strategies here. We develop properties from the ground up. We also buy value add, and we lend to properties as well, all in the multifamily space. We haven't bought anything in a few years for a lot of reasons. If you watched our other webinars, that's part of our risk management, our agility. We think development is still good today. It's been good for a long time because of the margins we can achieve. And there's exceptions to the rule in every market out there, but some markets are certainly better than others where we're looking today. We serve close to 3,500 investment partners. Many of those come from our RAA partners. About 70 are registered investment advisors, invest through Origin, and QOZ is their favorite product by far. So if you are an RAA and you're here today, welcome. Thank you for attending the QOZ webinar. David and I, we started Origin to manage our own wealth, and it really hasn't changed. We're still the largest investors at Origin. I'm proud to say that. And I would say that between our reputation being on the line, being on webinars like this, and our capital being at risk, we are highly aligned with all of our investment partners. And alignment is something from day one. It's been a core value of ours and really helps I guess, set the table for good investment decisions along the way in everything we do. And that's really embodied in our track record. We have 54 team members, 5 offices, about $1.5 billion in equity under management. And we're fortunate enough to be ranked as a top decile manager by Preqin. And that's really for the consistency of our returns across our 8 funds that we've run. It's not because one fund hit it out of the park. Our funds have either achieved top decile or top quartile performance. And as a manager, though, Preqin ranks us as top decile because that's very rare for managers to continuously and consistently produce those kinds of returns for investors. And we've never lost money on a multifamily asset. We've been also one of the most successful managers in the QOZ space in terms of fundraising. We're in the top 2% of fundraising in that market. And I remember when QOZ had sort of hit a frenzy in 2018 and everyone was announcing a new QOZ fund. There were more than 100 funds that were announced during that time. There were movie stars, news hosts, sports figures. They were all launching QOZ funds. And most of those funds have gone away. And really what you're left with is really high quality managers in the space. Those other funds, they were either unsuccessful in fundraising or unsuccessful in finding quality deals. And one thing we stressed to everyone back then, and I'll stress it today, is to make sure you invest with a manager who has a track record of executing in this space and is going to be around in 10, 15, 20 years, because there's really nothing worse than being in an orphan asset with an inexperienced manager or one who has totally checked out. And so Origin, for us, we have a saying, this is business as usual. We focus on the high net worth individual, the taxable investor, development as well. And we are built for longevity. We're going to be here for the next 10, 20, 30 years. David and I are invested in Fund 1, Fund 2. We're going to be investing in Fund 3. So our money is right alongside of you for the duration of this fund. Next slide, please. Basic fund overview. This fund is going to be investing in Class A ground-up developments in our target markets, and I define those as business-friendly, tax-friendly states. They're Sunbelt markets. Certainly not Chicago. That would be a whole other webinar, especially with some of the news that's come out recently. Dave and I have these conversations all the time. They're not fun, but I do live here. Dave lives here. We don't invest here, though, in Chicago any longer. The strategy itself can be described as build to core. We're developing properties with the intention of holding them for cash flow and appreciation. It takes about 2.5 to 3 years to develop the property, and the remainder of your hold period will be in a more core stabilized asset. So hence the build to core moniker, the strategy itself. And if you're going to be in it, the fund for 15, 20 years, 85, 90% will be in that core stabilized asset. The IRR in this case, it's always a range. It's the same as the other funds. It's 10 to 12%. We could certainly make that a lot wider. This is our best projection, but candidly, 10 years is a long time. So this could be higher or lower. We think we're always conservative on these assumptions here. The multiple on equity is the same thing, 2.25 to 2.5. This is the same projection as on our other two funds. And what that means, the multiple is simple. If you put in $1 million, that $1 million is expected to grow to about $2.25 million to $2.5 million. And that's the easy math behind that. Now, keep in mind, though, I'll get into the tax benefits in a second, but this is an after-tax return. So to earn a 2.5 multiple on an after-tax basis, you'd have to generate more than a 3x return on a multiple on a pre-tax basis. So the fund is extremely tax efficient, and it has some incredible benefits, which brings me to the next slide. The QOZ benefits and timeline. And so if you invest capital gains into this fund within 180 days of recognizing that gain, you get two benefits. One is a deferral and one is a forgiveness of taxes. And so let's go back to that $1 million investment. Let's say you realized you have $1 million gain, and it can be on anything. It can be on stocks, it can be on art, it can be part of private equity, real estate, what have you. If it's a gain and it happened in 2022 or within the last 180 days, and you invest that into our QOZ fund, the first one is you get a deferral of taxes. So you don't have to pay those taxes this year, but you do eventually have to pay them. And those taxes are recognizable in tax year 2026 and payable in tax year 2027. So you can look at it as it's a free loan from the government for a few years in this case, which is a nice benefit, but you're also going to be subject to the higher tax rate at that time. So there is some risk in that. The best benefit of this program, though, is the tax forgiveness. This is by far the biggest benefit. If they didn't even have the deferral, I think this benefit by itself would be enough for the program to survive and succeed. If you are invested in the fund for 10 years and 1 day, you will pay no taxes on your gains. So if that $1 million grows into $2 million, $3 million, $4 million, it doesn't matter. Once you exit that investment, you will have zero taxes owed on that. And that is by far the best benefit of this program. And the beautiful thing about the program itself and the way the law was written is that you still get the benefit of depreciation. So any cash flow coming back to you will also likely be tax-free as well, so long as we have enough depreciation to offset the taxable income from the portfolio projects. The last slide I'm going to cover before I hand it over to Dave is cash flow projections. And we get a lot of questions about this. How much cash am I going to get over the next 2 to 3 years? Am I going to be able to pay my taxes with this cash flow as well? And I can tell you that our goal is to return as much cash flow to you as possible through cash flow, through refinancing. Our estimate, just to be conservative, is that we're going to be able to return somewhere between 0 and 25%. And we say 0 because you should be prepared to pay taxes from a different source than cash flow and refinancing in that case. 25% is an estimate based on where we could be at the end of sort of, I wouldn't even say 2026. This fund is launching in June of 2023. So if you do the math, we'll be about 42 months into the fund at the end of 2026. And even if we were starting a deal today, we would be right at the edge of being able to refinance. Typically, we refinance between months 38 and 43, 44, somewhere around there, depending on how quickly we can build it, stabilize it, et cetera. And it could be that we return a lot more money, depending on where interest rates are, et cetera. There are just things outside of our control. And I'm sure most of you know this if you invested in real estate before, but interest rates, market values, lending standards, they're ultimately going to dictate how much money we can return to you at that point in time. If rates go back down to 0 and values go up significantly, we could return 50% by the end of 2027. Right now, 0 to 25% is our best estimate, and that'll start trickling in. I would guess kind of the beginning of 2027 and throughout the years. As it changes, we will update you, and we always do webinar recordings on every fund at least once a quarter, if not more. And as the information changes, we'll give that out to you. The other thing you should know about cash flow is that we are building a portfolio of cash flowing assets. So when this fund is done, there will be about 10 to 12 assets in the fund that are cash flowing, and that cash flow could be anywhere between 4 to 6% of your original investment, 5 to 7% of your original investment. The market today is a little upside down. Borrowing costs are actually above cap rates. There's not much cash flow in multifamily real estate, as we sit here, but the markets have a way of correcting themselves and righting the ship. And hopefully by the time we get to the point where we are in an environment where we're refinancing, that we'll have positive cash flow in all of these assets. And that's one of the things when we're talking about developing to a return on cost of 6%, that margin is that protection to make sure that we do have cash flow in the future. Because if you're generating a 6% cash flow and your debt costs are 5%, you're still going to have positive cash flow. It's just that existing prices today, you can't go out and buy multifamily real estate and put leverage on it and expect positive cash flow. It's just the market's upside down today. So I think my part was a little bit quicker than maybe I expected here. So Dave, I'm going to hand that time over to you. You've got some really interesting slides to go over. So take it away.
Thank you very much, Michael. And it's a pleasure to be back on a webinar with you. It's been far too long, and it's good to be back together as a team. Before I proceed, I just want to make sure everyone can hear and see me correctly, because I know we've been having a little bit of trouble with the Zoom audio visual. So does anyone have any idea or feedback? Just throw it in the chat. That'd be great. And I'll proceed, but I'll keep an eye out. So thank you for that. Someone says they can hear me. That's good. Thank you. So far, so good. Thank you, Chris. And thank you for joining us too. Michael mentioned we've done 8 funds. We remain our largest investor. We're going to be investing significantly in QOZ Fund III, and I'm going to take you through some of the reasons why. But just right off the bat, one question I want to address is directly, because they come in many shapes and sizes, but it's some form of the question, are there good deals left? This program's been around since 2018, and there's maps drawn, and are all the good sites taken? And I'm going to really drill down this on the case study we do, but the reality is there are a lot of good sites left, and we're super excited about the pipeline, the deals in this fund. And the reason is a lot of the times the deals that we've been working on since 2020, 2021, they're just taking shape and being actualized now. So I'll take you through that in a deal that we're going to proceed with in the Phoenix area. But this is a deal that we're literally 3 years into, and it's lining up with this fund. It's just a great example head on to answer that question. So Origin only focuses in multi, and then only focuses in multi in the Sunbelt states. I want to just sort of really hit on this theme of investment. And investment to Origin is the infrastructure that we build, the team that we build to find, to analyze, and to execute the business plans. And so the where we invest, which is in Florida, the Southeast, Texas, the Southwest, this is a decision we made 10 years ago. We decided 10 years ago that these are the areas of the country that people would want to live and work. And we also noticed that the capitalization rates, which are the multiples on earnings, were about, they were a little bit more attractive, meaning you're getting more multiples than you were in the gateways, kind of the New York, San Fran's, LA's, Chicago's. And that didn't make sense to us. I mean, you should pay more for a faster growing city, but you were actually paying less. And so what I mean by investment is, you see the dots. We're headquartered in Chicago, but Michael mentioned we don't invest in Chicago. This is where our investor relations and legal teams and accounting teams, some of our analysts are. But these other dots, the dot in Dallas, Texas, the dot in Denver, the dot in Charlotte, and Nashville, this is our production offices. And not only do we have people that have lived in these offices for 3 years, 5 years, 7 years, 9 years, but they're growing. This is where we're moving or hiring all of our new people, because we want our professionals that source and execute business plans to be living in the cities that they work. It's not arguable. If I said to you, we're a model, we're a bunch of people, 55 people that sit in Chicago and we fly around and come into cities, or I said, no, we actually live in the communities we work and execute business plans and form relationships, and we source better deals and we execute better deals because of that. Real estate is local. I think you'd have a really hard time defending the first business model. And yet most of our investment competitors, they do have that model. They sit in New York and they process data and they fly around. And I don't think that's a different model. I think that's a worse model. However, our model is much more expensive to execute. We have to finance 5, 6, 7 offices, not one. We have to file unemployment and all the labor laws, not in one state, multiple, et cetera. But it's better for you, and it shows up in the returns, and they speak for themselves. I'm going to touch on multilytics next. Next slide, please. So multilytics is a machine learning, artificial intelligence platform that we've been building for 3 years. And candidly, we won't stop building it. With technology, you just continually iterate and improve. We have 2 full-time data scientists. We're hiring a third. Where the beauty of this lies is we have an acquisition and investment management team with over 100 years of real estate experience. And in real estate, you call that feel. The feel for where an area will gentrify, the feel for what property would outperform another property and why. And the art in this whole process was how do you take that feel of someone like Dave Welk, who's been doing this, for 20 years, or Tom Briney, or myself, or Michael, or Mark Turner, and how do you instill that into a data-based machine learning model or series of models? And that's what we've been doing. We have covered this in entire webinars, but I will tell you, and we should continue to do that, and we publish. And one of the really interesting things, all of this data, 3 billion pieces of data that go into the model a month, it's all after one question is trying to solve, which is, what will rent growth be at a given address over a period of time, a year, 2 years, 3 years, 4 years, 5 years, because rent growth is revenue growth, and revenue growth is the single biggest driver of value in a model. That is our growth rate. And so We believe that this model isn't an incremental improvement on what's out in the market. There are other products that our competitors license. This is proprietary. We own it. Only we use it. We believe this is a giant step function above the competitor, meaning it's not 5% better, it's 300% better. And it's actually so good at this point that we're having discussions about what do you do with a model that's actually that good. It's so much better than in the market. And importantly, it influences everything we do now. Every investment decision that we make, it incorporates this idea of what is the machine learning saying. It doesn't make the decision for us, but it's incredibly important, both in credit decisions, refinance decisions, hold sell analysis, acquisitions. Everything that we're doing involves this. And so I want people to understand that we're leveraging this in a huge way and investing it. Again, back to investment. That's what you're getting here. Next slide, please. So I mentioned investment management. Mark Turner said it really well this week. I was in Charlotte with him, actually looking at a qualified opportunity zone development. And when his team takes over, once we decide to acquire an asset and we send out a term sheet and they accept it, then it goes into due diligence. Once it goes into due diligence, it's reevaluated. And if we decide to proceed, now we have a live deal. Once it moves to that phase, his team, and to be clear, there's 9 people in acquisitions, 9 professionals that only think about that. There's 9 people in investment management. I manage both of those teams. And so his job and his team's job is to execute the business model that's spelled out in the pro forma, which is essentially the investment memorandum. And he said it really well. He said, once you start a development, that pro forma, that business plan, it's just the starting point, and it's going to veer in many, many different ways. Because if you think about a development, think about the last few years, many of the variables that influence a development, the success of a development, went our way. Importantly, rents went up a lot, and that's good. That's your revenue. But many of them didn't go our way. Interest rates went up, much more than we had modeled. Construction costs went up in an inflationary way. And so his job is to veer and mitigate risk and reshape that business plan over and over again. And that's just in the development part. This slide here is talking about operations, because remember, you're not just hiring us to build. You're hiring us to build and then operate the asset. This fund is the juxtaposition of 2 very different business models. The first is a development phase, and that's typically 3 to 5 years to develop and lease and stabilize the product. And then there's what we call a core phase, where it's stabilized, it's cash flowing, and it's an operating asset. And this is speaking to the second phase, because we're quite good at that too. And so if we measure, and the graph is measuring our average leases, how many leases we're signing in our portfolio over the last 90 days versus the national average and competitors. And you would see that versus the national average, it's considerably higher. But even to the competitors, the higher set, we're 10% higher. Probably more importantly is the Google score. The Google score is measuring at the end of the day how many people are going to your property, how many people are going to the ratings of the property, which ultimately drives traffic, which ultimately drives leasing. And we've really been laser focused on this space, this virtual space, for the last 5 years, because apartment operations are a marriage or a hybrid of physical and virtual. And if you think about it, our whole world is that. Everything we do now is a marriage of the virtual along with the physical. And we're used to that. And it's no different here. If you're not winning in ratings and clicks and drives to the website, you won't win the physical. It's just not going to work. You don't have a big enough funnel. And then the thing on the top, number 3, best operator, really proud of that. That's out of 68 operators, we were number 3. And the reason I did it in this order is the only way to increase your Google score, to increase your ratings, how the property is rated, is to actually be good at operating it. People aren't going to give you good ratings unless they're happy. And so if you have a good physical product, if you have good service, if someone has a work order and you're able to fulfill and fix that work order and train your staff so they can also ask them, hey, by the way, I understand your dishwasher needs work, but is there anything else I can do in the unit while I'm here? That's called delighting the client. And when you delight a client, that's when you ask them for a review. You have to train and you have to have a good product. And what we do, everything is documented. We have a playbook for everything. So if you want to ever know what our playbook is development, ask us. We'll send you the 30-page document. You can read it. If you want to know how we operate every single asset, ask for the playbook. We have that too. There's a way that we do things, and it's done consistently at every property. Next slide, please. Here we've compared our QOZ development expertise. Again, it's all in multifamily. Michael mentioned more than the top 2% of equity raised in QOZ. If you just want a multifamily focused fund, and I would kind of answer that question. I would tell you do, because multifamily, if you just on the data alone, it's the highest returning, lowest standard deviation or lowest risk real estate asset class over the last 30 years. I also believe it will maintain that going forward. I think multifamily is not disruptible by technology. We have a fundamental need for housing in a way that every other real estate asset class might be. There were many on this call that maybe thought office wasn't disruptible, but now understand it is. I'm not so sure you can apply that logic to every other real estate asset class, including the ones that you think are correlating with technology. I'll give you an example. Cell towers, that's real estate. And it leverages technology, but what if someone comes out with better technology for transmission of data? Then what? Now you have a tower that's completely useless. It's salvage cost. And so I really like the asset class we're in. And if you want to be just in multifamily, we're the largest player in qualified opportunity zone. And we're proud of that. Our development experience is, if you look at the bottom, 510 million of sourced equity investment into qualified opportunity zone development, project cost of 1.77 billion. But on the left, we're really speaking to all of our development experience, which is 1.6 billion of equity. Much more proud of the 1.6 because we've been doing development for 10 years. And if you think about when we started in our second fund with the Olmsted, if anyone was in that fund with us, very successful deal in Atlanta. And then we had development in Fund 3. We had development in our Income Plus fund that's ongoing. Obviously, we had development in QOZ 01, QOZ 2. This will be QOZ 3. So you get a flavor of how long we've been doing development, and importantly, and it's not on this slide, how successfully we've done development. We've never had a development deal not earn north of 20% IRR across an awful lot of development. We never promise 20%. We never have in any deal we've ever done. We tend to over deliver and under promise. And I think that'll continue. I think we're very good at what we do. Obviously, some vintages will be better than others because of market conditions. I believe, and I agree with what Michael said earlier, this is a very good market environment to be entering development. I think a lot of the inputs are very stretched, meaning there's a great opportunity that we outperform what we're projecting. Next slide, please. This is our current development pipeline for QOZ 3. We are finishing up our investment in QOZ 2, and obviously we we stopped fundraising and capped that just around 310 million. We haven't mentioned this, but I'd like to. One of the reasons we're a top decile manager is we don't stray from what we're good at. And so number one, we're in one asset class. We've talked about that. But the other thing is, if you notice our fund sizing, it doesn't really change, right? So QOZ 1 was 260 million, QOZ 2 was 310 million. This is, also targeting 300 to 350 million. We stick in our lane because we know the deal size, we know how many good deals are available, and we want to match capital with good deals. And one of the things you should, whether you want to invest at Origin or not, one of the things you should keep in mind is be cautious about investing with a manager that was very successful at 200 million and now they're raising a $2 billion fund. I would tell you that's a totally different strategy, even from the same strategy. How do you put out 10x the amount of money in a similar time? That's a real risk. We don't do that. That's not what we're doing here. And I think a lot of that goes back to alignment. Since we're the largest investors, we want to continue to do the things that have been successful in the past, in the future. Next slide, please. So I want to hone in on this deal. This is a deal that, and I mentioned this right when I started, but this is the deal that really answers the question that we get an awful lot, which is, are there good deals left? You've done really well in QZ 1 and 2, but what's left now? So Anton Ballpark is a deal that we first looked at in Q1 2021. It's in one of our favorite submarkets in Phoenix called Goodyear. Why? Well, the growth rate in population in Goodyear is greatly outpaced Phoenix, and that's saying a lot because Phoenix has grown a lot. Our machine learning AI predicts very strong rent growth into the future, which is a very important part of any model. And a lot of the reasons for that would be how much supply is coming to a market versus population, that you want to have low supply and high population growth. You want to have affordability ratios, meaning the cost of rent isn't, more than 25 to 30% of income. Once it gets above that, it seems difficult to continue to raise rent. And here you have median incomes in Goodyear that are 30% higher than the metro area, which allows for that natural, you can raise rents because people can afford to do that. And you want to look for barriers for entry. And these are some of the things AI is doing, but candidly, it's some of the things that we are doing too, right? That's the benefit you get of living in a market and also being experienced in real estate. We're partnering here with a group called Anton Development. They're a vertically integrated builder. They've completed over 10,000 units in the Southwest. And importantly, they've been in business since 1995. Again, everything we do has a process, including how we partner with someone, who we partner with, how we underwrite our partner, because they also have to be excellent. We believe we're excellent. Our partners need to be excellent. And so if you're interested in that, we can share what a report on a partner, we would redact the group, looks like. What are we looking when we underwrite a partner? What do they need to look like? Because they're both a risk and an opportunity. The project itself is going to be 2 phases. When we initially looked at the project, we liked the area. It didn't meet our margin. We're looking for a 30 to 40% margin. And that was due to, generally at the time, the relationship between rents and building costs didn't line up. And so that's back to our discipline. We don't do the deal. We wait. We're still looking. We haven't given up on the deal, but we're not doing it. And we wanted to see some more elements introduced. It was traditional garden multi. We felt that there was a real opportunity here for build for rent and townhome integration. And that's what's happened to this project. We now have a 269 unit phase one of garden, more dense product. That's what the city wants. But then the phase two is townhomes and build for rent, 221 units, each requiring about 30.5 million of equity. And so this is an example of a deal. Again, it answers directly the question, what's left? Where are the good deals? And the reality is there's a lot of good deals that we've been working on for 2 years, 3 years, that are now making sense because the cost to build has actually gone down in Phoenix in particular. And the rents support now, to Michael's point earlier, a 6% return on cost, which back to this idea of margin, the spot cap rate in Phoenix currently is, in that sort of 4.3 to 4.5 range. And, if you start thinking about that, that's your 30 to 40% margin as well. Next slide, please. I'm going to turn it over to my esteemed partner, Michael, who's going to go over summary of terms.
Summary of terms. Great job, Dave. Yeah, I get the exciting part now, and then we'll move into Q&A. I think your timing was good. It's about 25 minutes, so we'll be finished up here in 2, and then we'll open it up for questions. So the terms of the fund, I said earlier, they're identical to Fund 1 and Fund 2. This is a unit-based fund structure. Anybody who comes in will be buying units at $10 per unit. We don't float until the money has all been raised and the fund is closed. There's no reason to mark assets to market on an early basis, especially when they're in the first innings of the development side. It is an LLC, so you will be getting a K1. There's no REIT blocker. There's reasons for that in this fund, why we didn't use a REIT as well, but this is, you will be getting a K1. The investment minimum is $50,000 in this fund. And then in terms of fees, there's a 1.25% annual asset management fee. There is a 50 basis point acquisition fee, and then a 10% performance fee subject to a 6% preferred return. And then there's a catch up in there. So you can think about the 10% performance fee as we get 10% of the profits. I'm sorry. Let me go back. I'm reading that wrong. 15%. I have actually the wrong fund. So the performance fee on this fund is actually a 15% performance fee subject to a preferred return, but there is a catch up on that. And then we have an admin fee, and that's to sort of equalize investors. So the more you invest, the lower that admin fee. It goes all the way from 2% all the way down to 0%. We do aggregate people. So if people come in together, we look at that as one single investment. So if you're interested in obtaining a lower admin fee and you have a group of people, we can get you that lower for you. The fund is audited, and we'll do that after we raise all the capital. The investments are in there. We'll be doing that on an annual basis. And those are, that's sort of high level summary of the terms itself. And you can take down the slides. And I'm going to actually grab the first question, because the first question is really related to the fees at Origin. And the first question is this: how does Origin's all-in fee structure, management, acquisition, carried interest, et cetera, compare to other QOZ products in the market? We actually do study the competition. We look at that. I will say that we're competitive. We're not the lowest cost provider, and we're certainly not the highest cost provider. Fees are always a function of value and cost, and I would say that we provide value well beyond the fees that we charge. And fees also have a lot of noise in them, so you have to go a lower, deeper and deeper and deeper. And as an investment manager, we do not typically do development directly. A lot of what we're doing is joint venture, holding other people's feet to the fire. We certainly don't do property management directly, and I don't think we ever will. I don't want to say never. But when you're looking at an integrated operator who's also touting a similar fee structure, you have to go down into those, because are they charging a 5% development fee or something more towards market at 3%? Are they charging a 3.5% property management rate, or is there a higher fee? So it's kind of the all-in. It takes a lot of people to manage real estate, but I would say from an investment management standpoint, when we're looking at this, we're sort of in the middle. Again, we're not trying to be the low-cost provider, and we certainly are mindful that fees destroy returns, and we're in this side by side with you all.
You want me to take one, Michael?
Please do, Dave.
All right, I'm in the chat, and I love the chat because we always tell people not to use the chat, but they do, and it's just awesome. I love it, and I'm dead serious. I think it's funny. So Wayne, I just wanted to thank you. Like, so nice. Wayne, I'll just read it. He says, I can't say this strongly enough. The presentation was good. As a current Origin investor, I'm seeking to shift all of my other CRE invested positions into your funds, etc. Wayne, honestly, that means so much to us. That's exactly why we formed Origin. Yes, we've outperformed other managers, but the other thing that you get, and I hope you see this, we're completely transparent and honest, and we are on this journey with you. And so, you know, I can tell you this from my standpoint, I haven't had as much luck investing with other managers, and I've tried across all kinds of asset classes. So I'm very concentrated based on data. I tend to do better here, but thank you for your kind comments. And I'm going to also answer, or actually, Michael, maybe you can in the chat. Jeffrey has a question. He's invested in multiple Origin accounts, funds, and he's wondering if that is pooled. Can it be treated as a total client, or is that fund specific? At least that's how I'm reading his question.
Yeah, for Wayne, I read your comment. Thank you very much. And I agree. I'm betting on David too. So we share that together. And in terms of aggregating all of the investments, no, it's kind of a product by product basis, but certainly if you are in more than one product, talk to your investor relations contact. You're going to have somebody who's dedicated. We can certainly work something out for you on the admin fee. We definitely want to reward loyal investors, loyal partners to us as well. So, but we don't have an aggregate program. For example, if you invest across 3 funds, you get a lower asset management fee, but some of the other, the admin fee is certainly negotiable.
I'm going to answer Chris's question, and then we'll move to the Q&A. This is still in the chat, Michael. Chris asked, can you share a tangible example of multilytics usage? And yes, I'll do it very briefly. So in our strategic credit fund, which is our second credit fund, our first was multifamily credit fund. We use multilytics because we're, you know, a lot of the bonds we're buying have 100 loans, and there's tremendous amounts of data in them. And so we use it as a sorting mechanism for the loans that we think we should spend much more time on, because we're flagging them as potentially a riskier loan. And a risk to a loan would be the inability to pay rents, which then lead to the inability to service debt. What would do that? Well, probably a lack of a growth rate of rents, which is what it's doing, right? And so that would be one example. Another example, we have what's called atemporal models. Those are models where you're regressing time out, and we're looking for long-term growth rates of cities and submarkets. It's been incredibly predictive, and we, unlike our competitors, meaning the licensed products, we're completely accountable to ourselves, meaning the predictions that we make are on the record. They don't ever backtest or publish their efficacy. We only do that. And so it's been incredibly predictive of long-term growth in both cities, submarkets, and even addresses. So we're using that constantly. Then at credit committee, or we call it investment committee, we have what's called an untrended return on cost. That's where you're regressing out rent growth. But then we also have a trended return on cost, because that's your true revenue. The trended return on cost, when we look at that, we're using multilytics predictive rent analysis. And so, like, there's just many ways that we're using it, but thanks for your question.
I'll grab the next one, Dave. This one, are there any updates on the QOZ tax law extension? And this is somebody who most likely watched our QOZ 2 or 1, this is something I mentioned last year. The answer is no. There's no update on any of that. I haven't heard anything. It was supposed to happen in Q1 of this year. I assume that since it didn't happen, it's not going to happen. And for those of you who have no idea what I'm talking about, there was a rumor in Congress that they were going to extend the deferral period from 2026 to 2028. And that would have brought back another benefit to the program called a step up in basis. That would have been fantastic. The news I got, it was from a good source, but clearly, leave it to Congress. Nothing has happened in that. So I'm not hopeful. So that's why we didn't even mention it on today's webinar. But thank you for the question. And if that changes, we'll definitely update everybody.
So I lied. There's another question in the chat, and it's a great one. So I'm going to cover it. Mark, thank you for your question, because I don't think we've answered this directly. His question is, when does the fund start? QOZ 3, I have capital gains that are realized in March of 23. Will it start within 180 days? The answer is yes. We will have this fund ready to accept capital by July 1st. That was confirmed this morning. The PPM, the legal, is in the final stages of compliance. So, Mark, you will have plenty of time to comply by investing into this fund with a capital gain realized March 1st. Thanks for the question.
Here's another question, and this one is kind of technical. Do short or long-term capital gains from trading securities count? And do you have to show flow of funds to the investment? Those are called 1256 gains. I'm actually familiar with those. I worked with one of our other partners on those, looking at them. There are some nuances to it, but generally, if it's just from trading, if you're day trader scalping in and out of stuff, then the answer is no, even though those are 60/40. And to my knowledge, that is honestly the only capital gain that is not eligible for QOZ. So that's unfortunate, and that's why. So we'll, yeah. Anyway, wish we could help you, but not with trading 1256 gains.
We have two questions about depreciation recapture. One is anonymous, the other is Pavan. Thank you for the question, and it's a good one. Technical, but it's important. So when you own a property, once you're done with the development and you have a cash flowing built property, you can depreciate it. That depreciation offsets income. And that's one of the wonderful things about real estate is you get dividends, but you don't have to pay taxes because you're having an offset of depreciation. Now, normally what would happen is your basis is being lowered in a non-QOZ property. Your basis is being lowered. When you sell it, now the capital gain that you're having to pay isn't based on cost or cost basis. It's based on that minus depreciation. So like in the extreme, if you bought something for $1 million and you depreciated it to zero and you sold it for 2 million, your gain isn't $1 million anymore because you already took the depreciation. So it's from 0 to 2. And so you're deferring, not eliminating. But what's really interesting about QOZ is because there's no capital gain tax to be paid and you get to depreciate, you get all the benefits of depreciation without the recapture. And so you're really winning twice. You're able to offset against cash flow during the hold. And then you don't have to pay a larger capital gain tax because there is none. And so it's something we don't talk enough about, but it's another reason Michael and I are very big investors in this. And the last thing I would tell you, and here's another benefit that isn't talked about enough. Yes, you have to hold 10 years to get the waiving of taxes, but you don't have to sell after 10 years. And I have no intention of doing that. I view this as an IRA. I don't have an IRA. I didn't do that. I wish I had. Didn't get good advice in my 20s, but now I've been given this lifeline. I get to put money into QOZ. It gets to continue to accumulate tax-free. It just keeps going up and up and up, and there's no. I mean, it's better than an IRA. So like that's the other thing. The law. Correct me if I'm wrong, Michael, it actually expires in 2046. Is that right?
I think you're correct there. Yes.
So it's not indefinite. You can't pass it on generation to generation, but in my opinion, there is no reason, unless you have a cash flow need, why would you sell after 10 years when it can continue to accumulate tax-free for the next 15 after that? So that's how I'm viewing it.
Yeah, and for those of you who don't know, we have built-in optionality. So you can get out after 10 years in a day, you can get out after 15 years, 20 years, whatever you want to do. And the way we do that is we'll poll investors, call it at 9.5 years, and we'll sell enough assets to get them out. So that's how the liquidity works. This question is from Anonymous. How does the 10-year tax-free hold period work with multiple investments, meaning that if you invest on June 1st and then you invest on November 1st and you layer them in there? And the answer is that it's 10 years in a day from the time that you make each investment. So they don't average those, they don't aggregate those together. So those are considered separate investments along the way.
We have a question. It's a really good question. I love questions that point out that we need to explain something clearly and more deeply. So Jason, thank you for your question about taxes that are due in 2026. And his question is, can you describe the taxes that are expected to be due in 2026 if fund projections go as planned? Jason, the taxes that are due in 2026, they're not a function of the fund, they're a function of your original capital gain. So you're deferring your capital gain, you don't have to pay it. So a lot of the, and it also answers a lot of the other questions we get about cash planning. How are you going to plan for me to pay my taxes in 2026? The reality is, if you didn't invest in QOZ, you would have to pay them next year. And so, the investor, if you have $1 million savings in capital gains, you needed to pay next year, but you didn't because you invested here. That original capital gain still has to be paid. And you need to plan for that. You're getting the value of your money for all of 23, 24, 25, 26. But that original capital gain has to be paid. It has nothing to do with us. It has nothing to do with how the fund does. It's your original gain. The next gain produced by this investment, there'll be no tax on at all. But the first gain is really a function of what you already did. So I hope that was clear.
Dave, I'm going to grab 3 questions in a row because these are quick answers. Can you give any good reason or at least debatable fact, this is by Jeremy, by the way, if you have capital gains, to put that cash into your income plus fund versus the QOZ? So look, Jeremy, they are a little bit different in terms of the risk profile, but Dave and I are consistent, and we say if you have capital gains and you want to be in real estate, there's no better program than QOZ because of the tax benefits. The Income Plus Fund is also a great fund as well, and it has a different timeline and a different risk profile as well. It's diversified, it builds, buys, and lends. So there's a couple things that would matter to you, but that's kind of the answer that I tell people. And if I have capital gains, generally I'm going to go into the QOZ fund, and after-tax capital I'm going to put into the Income Plus Fund. This next one is anonymous. I think you said in June you will take funds for Fund 3. What is the anticipated drawdown schedule? We don't draw them down. We take 100% of your capital all at once. So if you have a $200,000 gain, $500,000, million, we take that capital at once because we know it's really important for the investor to lock in those tax rates. From a management standpoint, it becomes a little bit challenging for us. We have to make sure that we're matching capital inflows with deal availability. And so we have to manage some cash drag, but it's worth it for this program and for you to get you those tax benefits. And lastly, Ayush said, if I put short-term capital gains into QOZ, will I still be paying taxes based on short-term gains? Yes, you will absolutely be paying taxes on short-term gains. They will not be converted to long-term gains in that sense. But that's one thing. This fund will take either, or the QOZ law accepts either long-term or short-term capital gains as an investment. So thank you for your questions.
All right. Kevin, thank you for your really kind thought. Kevin wrote, I echo Wayne's comment. As someone who used to work at a competitor, I won't name it, but it's well known, I can confidently say that Origin is a better investment for LPs. All the stuff that you read about, our competitors are good. They generally do the right things and we think highly of them. But I can tell you, I think we're better. I do. I think we're better at sourcing, executing, communicating, aligning, servicing. There's a reason that we've gone from 100 investment partners to 3,500 in a very short amount of time. That's not normal growth. It's because our clients are happy and they refer other clients. I mean, we don't spend a lot of money on marketing and advertising. And, importantly, this is another thing we don't talk about a lot. You're going direct to us. We don't hire a wirehouse, an investment bank, a distribution network. That's not what we do. And by the way, if we did, you pay for that. So the next time you're buying assets via those channels, like, understand they pass that on to you, and 100% of the time, in some way or form, you're paying for it. And we don't believe that that's necessary in today's, we have an efficiency that wasn't there 20 years ago, and you have access to data that wasn't there. Why wouldn't you just come in direct and not pay that? And that's a big part of, the thesis or the ethos of what we are. Michael and I were talking about this morning. We're now talking about disrupting another market that we think doesn't serve investors well and can be made better. And that's what inspires us. Like, that's literally what gets me excited, is when I see a market that's not serving people well, and you go, wow, we can do this better. I think we can.
I can attest to the fact too that Dave was very excited. It was a great conversation, and we'll be rolling something out next year. Rob, what is the specific tax reporting mechanism that triggers the deferral on capital gain on my 2023 return? I'm not a CPA. Good question. I'll get you that. I don't know the exact tax form. Your CPA or your accounting professional should have that information. It's not hard, but you can just email me too, and I'll get that to you, michael@origininvestments.com. There was another one. This one was, what about state taxes for deferral and forgiveness after 10 years? So it's a great question, because some states do recognize federal QOZ law, meaning that they opt in. So you get the same tax deferral and tax forgiveness at the state level. Others do not. So it's a state by state. You can Google, do a simple Google search, figure out if your state does in fact participate in the QOZ law.
Michael, did you cover anything about K1s?
Just that we're a partnership and there will be K1s.
Okay. There's an anonymous question about separate K1s for multiple states. We have a composite that you can elect to join, and so that would be one K1. I would advise you to join that. It makes it a lot more simpler for you. So that's the answer, is elect to be in the composite and you'll receive one.
Yeah, that's exactly it. And a lot of our states too that we're investing in, they're zero tax states, so there's no K1. It's not even necessary to file in those states. Dave, this is from Anonymous. This person mentions, Dave mentioned Origin is IRR driven, but terms indicate it is not, as no IRR hurdle. There is, I think you're talking about the terms and conditions here for this person. This is done by Anonymous. There is an IRR hurdle. Did I not go over that? I candidly, I don't recall if it's 7% or 8%. I have a lot of funds and deal merge because we've got a lot going on here, but those will be in the terms and conditions. But we absolutely have a hurdle, and we just don't believe that, we should get paid if we don't do our job. So if that's a 7% return hurdle, what that means is that if we don't make you at least that 7%, we don't get paid a performance fee. So we absolutely have that. Again, comes back to alignment and just believing in what we do. And holding our own feet to the fire. So that's something that we would expect any other manager to have if we were investing with them. And so we're absolutely going to put that term in our PPM as well.
Yeah, and you really have to do your homework. I was at a conference 2 weeks ago. We had a question, by the way, about strategic credit fund, when that is going to launch, and that's going to launch June 1st. So that's the answer to that. That's our second credit fund. But I was at a conference 2 weeks ago with other credit funds, and one of them seemed compelling, and I was talking to their founder. And again, I'm an investor too. Michael's an investor, I'm an investor. I don't just invest at Origin, I invest other places, and I was interested. And I said, well, tell me about your terms. And he was going through them, and I said, well, is there a catch up? And he said, no, there's no catch up. And I said, well, that's investor friendly, that's good. I said, well, what's your pref? And that's what Michael's speaking to. Our pref in this fund is 7, right? Meaning we got to get you 7% every year. And by the way, that's over 10 years, every year, every year, every year. And he said, well, I don't have a pref. And I mean, you don't have a catch up. If there's no pref, there's no need for a catch up either, right? Because he's sharing in every dollar that's made. And I was just blown away. He had $1 billion fund, and he was a sophisticated, I mean, somehow, somewhere he's raising money that's totally out of market. And so you have to be either educated about this, or you have to align yourself with managers that are not only competent, that's in order, competent first, and then fair second. Because if you get competency without fairness, you still aren't going to make money. And you're taking too much risk for the dollars that flow down. You need both.
Yeah, great point. We've both seen that in our careers. This question is from Anonymous. When you commit, how long until the capital is deployed? Worried about a cash drag on that capital? That's our job. And I had mentioned this earlier, to manage that cash drag, locking in the tax benefits, and also finding the deals itself. I would say that this fund benefits from all of the activities on Fund 2 and Fund 1. So David showed a robust pipeline even for where we are today. And all of that money is put into interest-bearing accounts that's FDIC insured at our banks. We actually use something called IntraFi. So regardless of how much money we pull in, that will actually be FDIC insured on that. So we're getting right around 5%. So it's not, the cash drag isn't the same today as it was 2 years ago when you were getting 0. And again, what we were talking about with the preferred return and the hurdles, we're highly incentivized to put capital out, as quickly as possible and in the right deals, so the cash drag doesn't hurt our IRR and ultimately get us below that threshold. So it's a great question and something to recognize. I always tell people that's one of the challenges from a management standpoint of operating a QOZ fund. In a called capital fund, it's super easy because we just call capital whenever it's available. It's capital on demand. In this, you're taking in advance of a lot of the properties that you're finding. But I'll take you back to QOZ Fund 1. We actually shut the fund down because we had more inflow, and it wasn't clear to us at that time how quickly we were going to be able to invest it. So we had a 6-month window where we were not taking capital, and we're not afraid to do that again. So if we get capital fundraising well ahead of development and deployment velocity, we again will shut it down. That's just what we do as managers, trying to balance the supply and demand of the capital and development opportunities out there.
Michael, we have a question, anonymous. Will this fund potentially benefit from distressed development deals? And secondly, will all deals be invested as an LP, or will Origin directly develop any of these projects? In terms of distressed development, we do have the ability to do that, and we will do that if it meets our cost of capital and its risk return. And so, of course, one of the things I probably should elaborate on a little bit, we see every deal in our market, and not only do we see it first. I mean, these deals are coming to us, and oftentimes I'll see a deal and it's funny because we've passed on it 8 months ago. And then a competitor of ours will do it. And you're like, okay, well, that feels good, right? That happens a lot. If there's distressed developments to do and they make sense, we'll do them. And so yes, you have that call option here. I will also say we're very, very experienced at distress. If it wants to go to distressed world, that was in our entire first fund. Short sales, foreclosures, deed in lieu, bankruptcies, we know how to do all of it. And so if it wants to go there, we've been very successful in that environment. In terms of direct development, we both invest as an LP. We invest as a co-developer. So for example, when I was in Charlotte on Monday, 2 of the 3 deals I looked at, we are what we call co-developers. We're sharing in the responsibilities and the revenue of the development side of the deal. Importantly, that revenue then flows to you. It flows to you through higher returns. It flows to you through shares in that waterfall. And so it's one of the reasons we outperform. And again, like I said before, you need competency and you need fairness, right? And we're fair to our investors. Like we could also just say, hey, we're sharing in the fees, we'll take it. It's not what we're doing, right? We're saying, no, we'll share in the fees and you'll benefit. And then the last thing we'll do in this fund, for sure, is direct development. We'll do that too. We have sites that we plan to directly develop, and that will save you lots of fees and money as well. But importantly, we think that we're good at development. Like again, in order, you need competency first. And so whether we're an LP, a co-developer, or direct developer, in all of these forms, you're getting the 9 people in investment management with decades and decades of experience in development and construction management and operations. That applies, right? So even if we're an LP, we're a really active, educated, hands-on LP, okay?
Dave, there's, I think I don't know if you want to end it now or keep going. It's 10 after. I'm going to knock out a few questions at once. These are short ones. Jeremy, do you invest in Ohio? I'm going to stop there because we do not. Our internal team actually emailed me the form that you need to file. This is from Anonymous. Form 8997 covers the QOZ contribution. So that's the form that you need to file. Ed asked, is the performance fee 20%? No, Ed, it's actually 15% after the hurdle IRR. So thank you for your question. And then Howard asked, will the slides be available after the recording? Absolutely. We always make those available. And then lastly, Will asked, how much, if any, leverage to use in QOZ Fund III? Target leverage, Will, on any development project is 65% loan to cost. And then generally on a refinance, we will be at 65 to 70%. And I know a lot of people are concerned about refinancing in today's market. Typically, when you're 65% loan to cost on a development where your margins are 35%, you'll be able to refinance out your capital, if not your equity, but refinance the existing loan and take out a substantial portion of equity. So we keep the leverage low because we don't have the opportunity to call more capital in the event that capital markets change, and then for some reason we can't even take out the existing loan. So we're being very conservative on that side.
So I think I'll answer one question and then we can send it off unless you have more, Michael. But to answer, Charlie asked a question: what MSAs in Florida are we targeting? MSA is just city, Jacksonville, Tampa Bay, Orlando. We're laser focused on those cities, and we've invested in qualified opportunity zone deals in all 3 of those cities in Fund 1 and 2. We'll continue to build that portfolio here. We are not thinking about adding more cities at this point. Again, we want to go a mile deep where we are. Not continue to just add more cities. And then your other question, Charlie, was about build for rent. will you include build for rent? And we absolutely will. We're, currently in pre-development or development on 5 build for rent communities across the country in our markets. And so we'll continue to build onto that. We're a big believer in that space. I guess the last thing I will say, and then Michael, I'll kick it to you, because I know you probably want to say goodbye and tie up any loose ends. But if we haven't answered any questions, and there are a couple that I see that are good questions, it's just we're quite a bit through here, a little bit over. But David at origininvestments.com, email me. I know Michael is Michael at origininvestments.com. Email him. We'll either answer, most likely we will, or we'll copy a relevant team member. I'm not the expert on everything. If you have an integrated legal difficult question, I'll integrate our general counsel and his legal. We have 3 professionals in our legal department, so I'm not going to impersonate a lawyer. I'll bring him in. But we value as investors, and we'll get back to you. So with that, I'm going to kick it to Michael.
That's it. I think that's a wrap, Dave. Thank you. Always great to be with you on a webinar, and hopefully we get to do another one in the future. So thank you, everybody. Appreciate you hanging in here until the end. It was an hour, 15 minutes, maybe a little slightly over what we had originally anticipated, but we really appreciate your time and the questions as well. So thank you.